4 million ounces of silver didn't crash, didn't get hacked, didn't vanish in a movie plot. It quietly disappeared from the COMEX vaults, and almost nobody is talking about what that really means. If you think this is just another routine inventory change, stay with me, because this moment could be far bigger than most investors realize. Right now, behind the scenes of the global silver market, something unusual is happening that doesn't fit the normal pattern. Bars that were supposed to sit safely inside official vaults are being pulled out, trucked away, and removed from the system entirely. COMEX is meant to be the backbone of paper silver trading, a place where contracts feel safe because physical metal is supposed to exist somewhere in the background. But when millions of ounces leave in a short period of time, it raises a simple and uncomfortable question. If demand for physical silver is supposedly weak, why are so many people rushing to take real metal out of the vaults? And if everything is fine, why does this keep happening again and again? Before we go any further, if you appreciate deep, calm analysis without hype, make sure you like this video and subscribe to the channel. It helps more than you think, and it allows the gray ledger to keep breaking down stories most people scroll past. Now let's slow this down, because the real story isn't the number itself, it's the timing. 4 million ounces leaving during a period when silver prices are still being held in a narrow range is not normal market behavior. Normally, when metal drains this quickly, price reacts almost immediately. But instead of a breakout, we're seeing silence, which is often more telling than volatility. COMEX vaults are divided into registered silver and eligible silver, and that distinction matters more than most retail investors understand. Registered silver is what can actually be delivered against futures contracts. Eligible silver, on the other hand, is metal that meets standards but isn't promised to anyone. When silver leaves the vault entirely, it belongs to someone who doesn't want paper exposure anymore. That tells us this is not speculative money. This is long-term, conviction-based demand for physical metal. Think about who removes silver at this scale. It's not a small investor buying a few coins. It's institutions, refiners, or industrial players securing supply. And this is happening while industrial demand for silver keeps climbing quietly in the background. Solar panels, electronics, military tech, and energy systems all depend on silver, and none of them can substitute it easily. At the same time, mining supply has not meaningfully increased. In fact, many silver mines are shutting down or scaling back due to costs. So when you see millions of ounces leaving a central vault, you're watching a pressure valve release. The system is adjusting, slowly but relentlessly. This is where most headlines stop, but this is where the real story starts. Because every ounce that leaves COMEX reduces the cushion supporting paper contracts. Futures markets rely on confidence, not just metal. As long as traders believe delivery is possible, the game continues. But belief weakens when vault levels keep falling, and no one explains why. Once confidence cracks, it doesn't come back easily. This isn't about a sudden collapse tomorrow morning. It's about a gradual shift where physical silver becomes more valuable than the promise of silver. That shift is subtle at first, almost invisible. But history shows it accelerates quickly once it reaches a tipping point. If you're still watching right now, you're already ahead of most people, because mainstream media rarely explains why physical shortages matter until prices have already moved. What we're seeing now is not panic, it's preparation. Smart money tends to move early and quietly. And when 4 million ounces vanish without a sound, it's usually intentional. Someone needed that metal more than they needed exposure to price charts. In the next part, we'll break down who is likely behind this drain and why this pattern keeps repeating. We'll also look at what happens if this trend continues into the next delivery cycles. Because once physical silver tightens enough, paper pricing loses control. And when that happens, the market rewrites the rules very quickly. Stay with me because this story is far from over. What's happening now may shape the silver market for years to come. To understand the scale, 4 million ounces is roughly 125 metric tons of silver. Imagine that in physical form, stacks of bars so heavy that moving them is a serious logistical operation. These aren't coins or small rounds. We're talking standard 1,000 ounce bars, each weighing about 68 pounds. Moving millions of ounces is not something done on a whim, and the numbers themselves tell a story. COM inventory reports show registered silver dropping steadily over the past months, with each report hinting at more metal leaving than coming in. When inventory shrinks this quickly, it isn't a coincidence. It's a signal that someone with access to big capital is securing real metal, not paper contracts. You might be wondering why this matters to someone watching at home. The answer is simple. Supply and demand still dictate prices, even in a market dominated by paper trading. Physical silver in the vaults represents deliverable supply. When that supply disappears, the leverage paper traders rely on becomes fragile. If enough physical metal leaves, a single large order could trigger delivery stress. And that's when futures markets start to behave unpredictably. Some analysts argue that silver isn't scarce because millions of ounces exist globally. But what matters is not global totals. It's what can be delivered immediately against contracts. Think of it like a bank. You might have deposits in the system, but if too many people demand cash at the same time, liquidity runs dry. The same principle applies to COMEX silver. And here's the twist most people miss. Paper silver can be sold endlessly, but physical silver cannot be conjured out of thin air. That's why this drain could be a precursor to volatility. Who benefits from quietly moving physical metal out? Institutions that understand scarcity and want control without alerting the general market. Retail investors rarely move metal in millions of ounces. Industrial players might secure it for production, but that still tightens available inventory for everyone else. And when large players accumulate, it's often done under the radar. The last thing anyone wants is a rush that spikes prices prematurely. That's why news about vault withdrawals rarely makes headlines. Yet for those watching carefully, the clues are their registry numbers, delivery reports, and unusual trading patterns. Over the past several weeks, COMEX registered silver has seen withdrawals that almost exactly match 4 million ounces. Every number, every report points to the same story. Less deliverable silver exists today than most people realize. And here's the kicker. This isn't slowing down. Month after month, more metal leaves than enters. And yet futures contracts continue to trade as if nothing is changing. That's the delicate balance of the silver market. Paper versus physical, promises versus reality. When that balance tips, the consequences can be sudden and sharp. If you're learning something new from this, make sure to like this video and subscribe to The Gray Ledger. We're uncovering the stories others don't explain, and this is just the beginning. Now imagine what happens if this trend accelerates. A few more months of withdrawals could drastically reduce available supply for deliveries. That's when institutional strategy becomes visible. Those who act early secure metal cheaply, while latecomers are forced to pay premiums. And it's not just about price spikes. It's about positioning. Controlling physical metal gives influence over the market, even without a single headline. Every ounce withdrawn reduces the comfort zone for paper traders. And when delivery stress appears, everyone starts questioning whether contracts can actually be honored. Futures traders know this, but retail participants often assume the system is endless. Reality, however, is far more finite and far more fragile than it looks on a chart. This is why careful monitoring of vault reports is crucial. Each number tells a story about demand, scarcity, and who's positioning for the next move. And while 4 million ounces may sound abstract, it's a concrete warning signal. When COMEX inventories reach critical lows, prices can react violently, and history shows they often overshoot. The gray area between paper and physical is where profits and risks are the largest. Those who understand it stand to gain. Those who ignore it risk being caught off guard. So far, we've looked at numbers, logistics, and institutional behavior. Next, we'll explore the geopolitical and global financial factors that might be quietly influencing these withdrawals. Because this isn't happening in isolation. Currency policies, inflation expectations, and central bank buying all intersect with silver markets. And understanding that intersection is key to predicting the next potential price move. Keep watching. Because in the next section, we analyze patterns from previous vault drains and what history might be trying to tell us. This is where theory meets reality in a way that could affect anyone holding silver, directly or indirectly. To see the full picture, we need to look back at previous COMEX withdrawals. There's a repeating pattern. Large amounts of registered silver leave quietly. Prices hold steady for a while, and then a sudden adjustment occurs. It's almost like a countdown. The market absorbs information slowly until the system can't ignore the scarcity anymore. In some past cases, deliveries had to be delayed because the physical metal simply wasn't there. When that happens, paper traders scramble, and premiums on actual silver rise sharply. This is the kind of stress that doesn't always show up on standard charts. It's invisible until it isn't. Now, consider who might be behind these movements. While we can't name names with certainty, the scale suggests large institutions, sovereign buyers, and possibly refiners looking to secure long-term supply. Sovereign buying is especially interesting. Countries like China and India have historically accumulated precious metals quietly, and silver is no exception. Industrial demand also plays a role. Every solar panel, electronic device, and green energy system built in the next decade will need silver, and shortages today can cause costs to skyrocket tomorrow. Withdrawals aren't just speculation, they're strategic. Physical silver is being positioned where it's most needed, long before anyone else realizes it. And here's a subtle but important point. Paper markets often understate the real story. Futures trading allows speculation without delivery, which creates the illusion of ample supply. But every ounce physically removed reduces the safety net. Eventually, that net disappears entirely. That's when price and reality collide. The paper market can resist for a while, but supply constraints always matter. Some analysts point out that silver inventories in other regions, like London or Zurich, haven't changed as dramatically. That suggests the COMEX drain is not global panic, it's targeted, strategic accumulation. And this accumulation usually happens quietly, without the fanfare you might expect. Large buyers don't announce their moves, they just secure what they need. The question for everyone else is timing. How long before scarcity begins to pressure the broader market? 4 million ounces is a lot, but it's only part of the story. combined with declining mine production and rising industrial demand. The potential for a significant supply squeeze emerges. Historically, these conditions have led to rapid price surges. Markets under stress often move faster than anyone anticipates. And here's another factor: investor psychology. Once word spreads that physical silver is being withdrawn in large quantities, fear of missing out can accelerate buying. That's a self-reinforcing cycle. Withdrawal creates scarcity. Scarcity triggers demand. Demand drives prices higher, and the cycle repeats. For someone watching at home, understanding this dynamic is crucial. Most retail investors react late because they focus on charts instead of fundamentals. Fundamentals are what we're looking at here: real metal, real demand, and real scarcity. Charts can lag, but vault numbers don't lie. And when we combine COMEX withdrawals with global trends like rising industrial demand and central bank activity, the picture becomes clear. We're heading toward a tighter physical market, whether paper markets acknowledge it or not. Some skeptics argue that silver is too cheap to move dramatically. But price suppression in paper markets doesn't change the fact that actual ounces are finite. The moment delivery becomes an issue, paper prices must adjust to physical reality. And those adjustments can be sudden and dramatic. That's why monitoring COMEX inventories is more important than any technical indicator. Every report tells a story, and patterns are emerging faster than most realize. If you're following along and finding this useful, don't forget to hit like and subscribe to The Gray Ledger. Our goal is to connect the dots that others leave scattered. Now, consider the next potential scenario. If withdrawals continue, shortages could ripple through industrial sectors. Prices for actual silver could spike before the broader market anticipates it. That's when premium bars, coins, and ETFs backed by physical metal could see real movement. Futures might still lag, but the real-world cost of silver will reflect scarcity. And here's the human element. Investors often underestimate timing. By the time headlines report shortages, early movers have already secured their positions. This is why quiet accumulation matters more than loud announcements. Strategy in silence beats speculation in public. In the next section, we'll explore how these dynamics might play out over the coming months. We'll look at supply, demand, and market psychology to anticipate the possible outcomes. Because understanding patterns is the key to preparation. Preparation, not panic, is what separates smart investors from the rest. If you're ready, the final part will tie everything together. We'll discuss the implications for everyday investors, industrial users, and those watching silver as a hedge. Keep following carefully, because this story is far from over. And 4 million ounces disappearing quietly is just the opening act. Looking ahead, the continued drain of physical silver could set the stage for one of the most significant market shifts in years. The key factor isn't speculation, it's supply. When deliverable ounces run low, price action eventually follows. Remember, futures contracts are promises, not metal in hand. They work as long as people trust the system, but trust erodes when shortages appear. The more silver leaves COMEX, the thinner that trust becomes. And when confidence falters, markets can react suddenly, sometimes violently. For industrial users, this could mean higher costs and supply challenges. Every sector relying on silver electronics, photovoltaics, medical tech faces the reality of constrained metal availability. For investors, understanding this isn't about short-term trading. It's about positioning for a fundamental shift where physical scarcity dictates price, not charts. Consider the impact if just a fraction of that 4 million ounces were needed for immediate delivery. Prices could spike overnight, reflecting real-world demand rather than paper assumptions. What's particularly important is timing. Early movers secure metal at lower costs, while late entrants face premiums and competition. And we've seen this story before. Markets resist at first, then adjust abruptly once the scarcity signal becomes undeniable. One overlooked detail is how these withdrawals affect leverage. Paper contracts assume the existence of physical metal, but every ounce removed increases the risk for traders relying on deliverable silver. That's why some analysts warn that the next few months could be critical. Small disruptions in supply could trigger ripple effects across futures and spot markets alike. For everyday investors, awareness is key. Watching vault reports, registered silver changes, and global demand patterns offers insight far ahead of price spikes. And while volatility might feel intimidating, it's actually a natural response to an imbalanced market. History shows that significant price moves often follow sustained physical withdrawals. Another factor to consider is geopolitical influence. Countries accumulating precious metals quietly can tighten the market even further without a word in the headlines. Industrial, governmental, and institutional buying all intersect with these withdrawals. When aligned, they create a perfect storm of scarcity, long before most retail participants notice. And here's a subtle point. Psychological impact matters as much as physical supply. When investors realize large volumes of metal are no longer available, FOMO drives accelerated demand. That creates a self-reinforcing cycle. Scarcity fuels higher demand drives prices, and the cycle can accelerate rapidly. At the same time, COMEX and futures markets often lag reality. Contracts continue trading as if everything is normal, while physical inventory quietly tightens. This discrepancy between paper and physical markets is where opportunities and risks emerge. Those watching carefully have a chance to position themselves before widespread recognition occurs, but patience is critical. Acting too early without understanding the dynamics can be just as costly as reacting too late. This is why tracking registered silver and vault reports is essential. The data doesn't lie, even if headlines ignore it. And for viewers of the gray ledger, understanding these subtleties is part of long-term strategy. Silver isn't just a commodity, it's a story of supply, demand, and human behavior playing out in real time. 4 million ounces gone might sound abstract, but it's very tangible when you consider what that metal represents: security, scarcity, and positioning. Every ounce removed changes the landscape for everyone trading, investing, or relying on silver. So what happens next? If withdrawals continue at this pace, physical shortages could create noticeable premiums on silver bars, coins, and ETFs backed by metal. Futures might still lag, but real-world prices will reflect the reality of supply and demand. And once the gap between paper and physical becomes obvious, market behavior changes quickly. That's the ultimate lesson. Silver scarcity is real, and the market is already signaling it through these withdrawals. Understanding that signal gives early movers an advantage. For those watching closely, this isn't just about investing, it's about awareness. Every vault report, every withdrawal, and every report is part of a puzzle that few people connect. And now, more than ever, awareness is power. Knowing the scale, the strategy, and the potential impact positions you ahead of the curve. If this analysis has helped you understand the bigger picture, make sure to comment below. Share your thoughts on what you think could happen next, and discuss the implications with others who follow silver closely. Sharing this video also helps more people uncover the story behind the headlines. The market moves quietly at first, but collective awareness can make a difference in strategy. In summary, the COMEX vault drain of 4 million ounces is more than just a number, it's a signal. A signal that the silver market is quietly tightening, that physical metal is being prioritized, and that paper contracts may not tell the full story. Investors, industrial users, and market watchers all need to pay attention. Scarcity may not hit instantly, but history shows it can accelerate faster than anyone expects. At the Gray Ledger, we aim to connect the dots others leave unexplored. Understanding withdrawals, market psychology, and global demand is essential for anyone serious about silver. Physical scarcity is not a future threat, it's happening now. And how you respond could determine whether you benefit from these trends or get caught unprepared. Every ounce withdrawn is a reminder that silver is finite, demand is real, and timing matters more than ever. This is a story of strategy, patience, and understanding the mechanics of the market. So pay attention to the details, watch the vault reports, and follow trends carefully. Physical metal doesn't lie, and it's often the first indicator of market stress. Finally, don't forget to like, comment, and share this video with anyone tracking silver. Conversations and awareness are how we all stay informed and prepared. The disappearance of 4 million ounces from COMEX isn't just a headline, it's a signal. And for those watching closely, it could be the beginning of a defining moment in the silver market. Stay alert, stay informed, and remember, silver moves quietly, but its impact is anything but small. The Gray Ledger will continue following the story, breaking down updates, and helping you see what most investors miss. Every report, every withdrawal, and every strategic move tells a story about scarcity, positioning, and market psychology. Those who understand it are always ahead. So, keep watching, stay patient, and consider carefully where the market is heading. The next few months could be decisive for both physical silver and paper markets. Comment below with your thoughts, share this video with fellow investors, and make sure you're part of the conversation. This is where knowledge meets strategy, and awareness can make all the difference. The silver market is tightening, withdrawals continue, and the next chapter is being written quietly, bar by bar, ounce by ounce. Stay informed, stay prepared, and follow the Gray Ledger for the latest insights. And remember, scarcity isn't theoretical, it's already here. How the market reacts next will be a story worth watching closely. Thank you for staying with us through this analysis. Like, comment, share, and subscribe. And stay tuned as we continue to track these critical developments in the silver market. 4 million ounces gone might not make the headlines yet. But for those who watch carefully, it tells the story of a market quietly changing. Timing, strategy, and awareness are key. Keep following the Gray Ledger. The story isn't over, it's just entering a critical stage.